So, Ivory, how do you see today shaping up? What is your word of the day?
My word of the day is liquidity. It's interesting. Global liquidity actually peaked in the beginning of October and it's dropped precipitously. And the reason that's important is because there's usually a 70-day lag between global liquidity and Bitcoin. But it's instructive to know that NASDAQ is actually very correlated to global liquidity as well. So I think it means that we're going to have a choppy market the next month or so. But I think that's a short-term, phenomenon. I think global liquidity will actually reaccelerate in 2025. But in the short term, it could mean a little bit more volatility.
More volatility going forward. How big of a factor in that volatility thesis on your part is the rise of the dollar? I'm looking at the chart right here. Since election day, the dollar's up over 4.5%. At the same time, the rise in bond yields. Bond yields up just about 1% since the election, moving even higher, not moving even higher, but also moving about 20 basis points higher since that hawkish cut. How big of a concern is that overall as we look into 2025?
Not too concerning. I mean, when the dollar goes up, non-dollar users have a harder time getting access to credit, right? We've also at the same time gone from rate expectations of 4 rate cuts to 1 or 2. I'm not concerned because that when I say the global liquidity will reaccelerate, the government has to refinance about 30% of its debt next year. At the same time, there's going to be another $2 trillion in deficit spending. So all this has to be monetized. And then don't forget that China's going to have about a 4% budget deficit. They've already pledged to have loose monetary policy. So we assume that liquidity will rebound. And yields are going up, I think, because there's an expectation of growth and inflation.
So wait, you're not concerned about the impact of yields and the dollar on the equity market at all?
Not in the short term. In the short term, yes. So I think in the short term, that's going to cause some volatility. But I think that the liquidity is going to rebound in 2025 for the reasons I just mentioned.
Okay.
You're going to have central banks.
I got you. Is there one sector that you think, at least in the short term, is the most impacted by this rise? Again, I'm talking about the dollar up 4.5% since the election. That's a big, huge upside move for currency.
So the dollar going up isn't good for gold, and it's probably not good for Bitcoin, right? So those two sectors are probably the ones I'd be most concerned about. I wouldn't be surprised if we saw crypto back off from here, at least for the short term. So those would be the two ones I'd be most concerned about.
So I've been actually talking to a few traders. I want to ask you, do you think bond yields are starting to become competition for the equity market? I mean, again, we're looking at the 10-year at 4.6. A lot of people think that's going to get up to 5%.
I don't want to make predictions of where I think it goes, but it's, I think, more a barometer of where we see inflation. Don't forget, CRB index is up 6.7% in the fourth quarter. Inflation has reaccelerated, particularly if you look at core inflation. And that's a function, too, of wage growth. I mean, wage growth has gone up about 4.5%. That might get exacerbated because we know 4 million new workers come into this country every year, 2/3 are illegal, and there's a shortage of labor. 75% of the wage growth is from service sector. So I think the yields reflect the fact that we know that there's going to be GDP growth. The GDP growth is probably doubled since the first quarter of the year. And also we know that inflation is going to be sticky going forward.
So Ivory, we want to get to your pick. What is your pick for us today and why?
Oh, I think it's Bitcoin. And NASDAQ to some extent also, but Bitcoin, because when you increase liquidity, what's happening is we're debasing our currency. We have about $7 trillion in debt that has to get refinanced at much higher rates, and we're going to have to monetize that debt, which means the Fed prints money. I think people don't realize the Federal Reserve is the largest owner of U.S. debt. It's not China, it's not Japan, it's the Federal Reserve. Because they're printing money, they're buying treasuries in the open market, and that money is then used to lend the government more money. So we're just debasing our currency. That's going to accelerate in 2025, not just what's happening in the U.S., but globally. And I think when you buy Bitcoin, as I've mentioned before, you're exchanging something in abundance, which is a dollar, for something that's scarce, which is Bitcoin. It's only going to be 21 million coins ever mined, and about 3 to 4 million have been lost. So I think there's a lot of reasons to buy Bitcoin, notwithstanding the fact that crypto is the biggest investor in this latest presidential cycle. They don't just have a seat at the table, they actually bought the table. They're ordering the takeout, they're tipping the waiters. So that might influence policy and create adoption rates. We've already seen the Bitcoin Act, where they want to make Bitcoin a reserve asset on the balance sheet of the Treasury. So that's a narrative. But policy also, don't forget, If you have tax
Okay.
cuts and they have to borrow money to pay for the tax cuts, again, monetizing the debt increases Bitcoin.